Welcome to Deep Dive. Today we're tackling something really fascinating. We're going to try and flip the usual thinking on poverty. What if, instead of just seeing it as a burden, we saw it as a strategic investment opportunity?
Yeah, exactly.
You've shared some great sources on this, and our goal today really is to pull out the key insights, maybe some surprising facts, and, what it actually means to look at poverty like an investor.
That's right. We'll be digging into this idea of a dual return. So investments that can actually give you solid financial returns and make a real social difference.
A dual return.
Yeah, it's a shift, isn't it? Moving away from just like aid towards seeing real economic potential that's been untapped because, well, the market hasn't quite worked properly there.
Okay, let's unpack that. This shift from aid to investment. The sources definitely highlight how, the old way often just treated symptoms. But now we're seeing this thing called impact investing pop up. And it seems driven by two things at once. Doing good socially, but also getting a financial return.
And the economic thinking behind it is quite interesting. Often, the old view sort of blamed individuals, right? Which limited what people thought could be done.
Right.
But a wider view sees systemic problems, basically. Not enough capital, not the right partners, communities not engaged enough in low-income areas. So impact investing tries to use private money to fix those specific gaps, unlock potential.
Okay.
And there's even a psychological angle. You might think inequality makes people cautious, but some studies suggest inequality of opportunity can actually make disadvantaged groups take more financial risks.
Kind of a drive to catch up.
Wow, okay. That adds another layer. So this isn't just like an academic idea then.
Yeah.
How did it actually start moving into the real world?
Well, the term impact investing itself, that was apparently coined around 2007. But it really picked up steam after the 2008 financial crisis. People started asking harder questions about what investment is actually for.
Right, rethinking things.
Exactly. And then the Global Impact Investing Network, or GIIN, got set up in 2009. That's been a big player in making this a proper field.
And the scale now is pretty big.
Huge. The estimates for 2023 were something like $1.164 trillion in assets under management.
Wow.
And they're projecting it could grow to maybe $7.7 trillion by 2033. It's all fueled by this idea of blended value, basically, that economic, social, and environmental value are all tangled up together. You can aim for all three.
So for you listening, the big question is always, what about the returns? The actual money side.
It varies. Financially, you see a real mix. Some investments or concessionary investors might accept a slightly lower return because the social impact is massive.
Okay.
But others deliver competitive market rate returns. They perform just as well as traditional investments.
And the social side, can you actually measure that?
You can, and some examples are pretty remarkable. Deworming programs, studies show returns like over $648 for every $1 invested.
$648, seriously?
Yeah. And measles vaccinations, around $44 for every $1. Even things like social impact bonds. The Peterborough one in the UK paid investors about 3% a year and cut reoffending by 9%. So these aren't just small gains.
Not at all. They show that tackling these social issues can have really high measurable returns. It kind of flips the script on what a valuable investment is. And there's a multiplier effect, too. Jobs from building affordable housing, better health saving costs later, financial literacy empowering people. It ripples outwards.
Okay, so how does this actually work on the ground? What kind of investments are we talking about?
Well, microfinance is a big one. Giving small loans to entrepreneurs who can't get them from banks. That sparks local business, builds networks.
Makes sense.
Affordable housing is another huge area. Just the lack of affordable housing costs the U.S. economy something like $2 trillion a year.
$2 trillion?
Yeah. And on the flip side, research suggests every dollar invested in reducing childhood poverty could save the economy at least $7 down the line.
That's a powerful statistic. And you mentioned social impact bonds, SIBs.
Right, SIBs. They're interesting. It's a pay-for-success model.
Yeah.
Private investors put up the money for a social program, and the government only pays them back, maybe with a return, if the program achieves specific pre-agreed results. So the financial risk sits with the investors, not the taxpayers, unless it works.
Clever. But it can't all be easy, right? What are the catches?
Definitely challenges. You have to be careful about impact washing.
Impact washing.
Yeah, where maybe the claims about social good are, let's say, exaggerated, more marketing than reality. Also, measuring social impact is just harder than measuring financial profit. It's not as standardized yet.
Right, that seems like a big hurdle. How do you know if the impact is real?
That's where things like standardized frameworks become really important. You've got the UN's Sustainable Development Goals, the SDGs.
Okay.
GIN has its own system called IRIS Plus for measuring impact. And methods like SROI, social return on investment, try to put a kind of financial value on the social outcomes. These tools bring transparency, credibility.
So standards help.
They do. And also approaches like using patient capital funding that's long-term, flexible, understands results, take time. Plus, blended finance, mixing public and private money to lower the risk. These things help unlock investment in places that looked too risky before. Okay, so pulling this all together, looking at poverty as an investment seems to offer this powerful dual return you mentioned, money and meaning, basically.
Absolutely. But realizing it takes work, careful design, real measurement, and strong ethics. So it's not just talk. It really calls for, different sectors working together much more closely for real systemic change.
So here's a final thought for you to take away. If the definition of a good investment is actually changing, if it now has to include not just profit, but real verifiable social and environmental good, how does that change how you think about creating wealth and what it's truly capable of?